When stocks crash, the first feeling is that money has vanished. One day the market is worth 10 trillion. The next day it is worth 9. People ask a simple question: where did that trillion go? Here is the clean answer: most of it did not go anywhere. It was never a pile of cash sitting on a table. It was a price multiplied by shares based on what buyers and sellers believed in that moment. When belief changes fast, prices change fast. That change looks like money leaving, but it is mainly value being rewritten. Picture a crowded auction. A painting sold yesterday for 1 million. Today, the highest bid is 800,000. Did $200,000 fly out the window? No. The painting is the same. The crowd is different. The mood is different. The price is different. Stocks work like that, only louder and faster. A stock price is the last agreed deal between a buyer and a seller. It is not a full report on every share. Most shares did not trade at that moment. Yet that last deal becomes the price for all shares when we calculate market value. So a tiny set of trades can reprice a giant number of shares. That is why the market can lose $1 trillion without $1 trillion physically moving. It is the same reason your house can lose value when a neighbor sells cheaply, even if you never sold your house at all. Now put numbers on it. A company has 1 billion shares. Yesterday, each share traded at $100, so the market value looks like $100 billion. Today, the last trade is $90. Instantly, the market value looks like $90 billion. Headlines say the company lost $10 billion. But the cash that actually traded might have been only a few $1,000,000 worth of shares. The rest is the market applying the new price to all shares, even the ones that never moved. This is also why markets can fall even if you personally did nothing. Your retirement account can drop in value while you were asleep because the E-buys up. Market's last price changed, not because your broker removed money from your account. It also helps to know what a stock is. A stock is a claim on a business, its future profits, its dividends, and its growth. When investors think those future profits will be smaller or riskier, they pay less today. In crashes, the story often changes quickly. Higher interest rates make future profits worth less in today's dollars, recessions threaten sales, and fear makes investors demand a bigger discount to take risk. That discount shows up as a lower price. Notice something important. When a stock price falls, the company's cash in the bank does not automatically disappear. The factory is still there, the employees still show up, the company may still be profitable. The stock is a trading price for ownership claims, not the company's daily cash register. The price can fall first, and the business may weaken later or recover later, depending on what happens in the real economy. Still, cash does move during a crash. It moves in specific directions, through specific channels. To understand it, you need to separate two ideas: price and cash. Price is what something is worth right now. Cash is what actually changes hands when someone buys or sells. Start with the simplest trade. You sell a stock for $100. I buy it for $100. Where did the money go? It went to you. Where did the stock go? It went to me. Nothing disappeared. The same is true when the price falls. If you sell at 60, the buyer pays 60 and you receive 60. The missing 40 is not a bag of cash. It is the difference between what you hope to get and what the market is willing to pay. So where does the money go when the whole market drops? It goes into 3 places, depending on which money you mean. First, it goes into the past. Many people bought earlier at higher prices. That money went to someone else at the time of purchase. When prices fall later, nobody returns the earlier. Cash. It is already spent, saved, invested, or paid as taxes by the earlier seller. A crash does not rewind old trades. It only changes today's price. Second, it goes into the hands of buyers who are willing to buy at the new lower prices. When fear rises, sellers accept worse deals. Buyers demand discounts. The cash that buyers keep by paying less is not new cash created. It is simply cash that stays in their accounts instead of being transferred at higher prices. Third, it goes into safer places because investors rotate. During a crash, many people sell risky assets and buy safe assets. That often means government bonds, especially U.S. Treasury bonds, or cash-like instruments such as money market funds. It can also mean gold. The key is that money is not teleporting out of the system. It is changing ownership and changing form. And when people rush into bonds, bond prices rise, yields fall, rewarding those who already held safety assets overnight. But there is a deeper layer. Many crashes are not just fear. They are forced selling. Imagine you bought $100,000 of stock with $50,000 of your own money and $50,000 borrowed from your broker. If the stock falls, your broker may demand more collateral. This is called a margin call. If you cannot add cash, the broker sells your shares to protect the loan. That selling pushes prices down, which triggers more margin calls, which triggers more selling. This is how a fall becomes a slide. In that situation, where does money go? Some of it goes to repay debt. The broker sells the stock, takes cash, and uses it to reduce what you owe. That cash may then go back to the lender or sit as reserves or be used elsewhere. The loss is the drop in your equity, not a sack of dollars sent into space. The same logic applies to big institutions. Hedge funds, banks, and traders often use leverage. Leverage makes gains bigger, but it makes losses faster. When volatility rises, lenders tighten terms. Financing. Costs rise. Risk limits get hit. Funds must sell. This is why you see the phrase deleveraging during crises. It means positions are being reduced because the borrowed money behind them is being pulled back. Now, consider another common misunderstanding. If everyone is selling, who is buying? Someone always buys because every sale requires a buyer. The price falls until enough buyers appear. In a crash, the buyers are usually the ones with cash, patience, and a long horizon. Sometimes they are individuals. Often they are large institutions that rebalance portfolios, or market makers who provide liquidity for a spread, or investors who believe the market has overshot. So the cash does not vanish. It changes hands, often from panicked sellers to calm buyers. The market's value falls because the last agreed price is lower, not because the cash was vacuumed away. Yet the pain is real, because wealth effects are real. Even if money didn't go anywhere, people feel poorer. They cut spending. Businesses delay hiring. Consumers become cautious. That reduction in spending can slow the economy, which can justify lower profits, which can justify lower stock prices. A crash can turn into a recession not because the market lost physical cash, but because the market changed behavior. So why do crashes feel like a drain? Because people use those prices as their sense of wealth. If your portfolio was worth $200,000 yesterday and $150,000 today, you feel $50,000 poorer. You may delay buying a car, delay renovations, or cancel travel. Millions doing that at once can slow the economy, which then pressures company earnings. The market is not only a scoreboard, it can become part of the game. There is also a global flow story. When markets panic, international investors often move money toward the perceived safest and most liquid markets. In many cases, that means dollars and U.S. treasuries. You may hear flight to safety or flight to quality. These are not poetic phrases. They describe a real pattern. Money moves from risky assets to assets that are easier to sell, easier to value, and more likely to be honored in crisis. This can cause some currencies to weaken. If foreigners sell a country's stocks and then sell the local currency to buy dollars, that currency falls. Imports become more expensive, inflation pressure can rise, so a stock crash can spill into currency markets, especially in smaller or more fragile economies. Another destination for money during crashes is simple cash, meaning bank deposits and short-term government bills. Some investors do not want to hold anything volatile. They accept lower returns for the comfort of stability. They move into treasury bills, high-quality money market funds, or straight cash in a bank. Again, the money is not gone, it is parked. But there is a crucial detail. Cash is not a physical pile either. Modern cash is mostly bank deposits, which are entries on bank balance sheets. When investors flee to deposits, banks' liabilities rise. Banks may then buy safer assets or increase reserves or shorten lending. That can tighten credit in the real economy. So the flow into cash can still have consequences. Now consider the opposite. Sometimes money does not flee into safety. Sometimes it flees into the one thing that must be paid, debt. In a crash, people who borrowed must reduce risk. They sell whatever they can to meet obligations. This is why you often see good assets fall along with bad assets. Investors are not selling because they hate the asset. They are selling because they need liquidity right now. Liquidity is a simple word with a sharp meaning. Can you sell quickly without taking a huge discount? In calm markets, liquidity feels infinite. In panic, liquidity disappears. Bid-ask spreads widen. Buyers step back. The market demands bigger discounts. That is when the question, where does money go, becomes urgent, because people discover they cannot turn assets into cash at the prices they expected. Central banks enter here. When markets freeze, central banks may provide liquidity to keep the system functioning. They lend to banks. They buy government bonds. In extreme cases, they buy other assets. This is not to prop up stock prices directly, but to prevent financial plumbing from clogging. When the plumbing works, panic can settle. When it fails, forced selling accelerates. There is one more place the cash can go: to whoever is positioned for the fall. Short sellers borrow shares, sell them, and hope to buy them back cheaper. Options traders may profit if they bought protection. In those cases, money is transferring from those who were exposed to the crash to those who hedged it. Again, nothing vanished. It moved according to contracts. So, to answer the question with precision, when stocks crash, the money goes mostly into lower prices, not into a secret location. The cash that moves goes to sellers, to debt repayment, and into safer assets like government bonds and cash-like instruments. What disappears is not cash. It is confidence and valuation. If you want one image to remember, use this. The stock market is a voting machine in the short run and a weighing machine in the long run. In a crash, votes swing. Fear, votes are loud, prices drop quickly. Later, as panic fades, the weighing begins again: earnings, cash flows, and economic reality. The final lesson is practical. If you watch a crash and ask, where did the money go, you are asking a house valuation question, not a bank balance question. The price of the asset changed. The wealth on paper changed. Behavior changes next. That is how market crashes become historical events, not just numbers on a screen.